For all you self-directed investors, we're going to calculate your required minimum distributions from your IRA in 4 steps. You've been deferring this all the time. You now have to pay the IRS what they're due. Let me show you how to do it. All right, so you have IRAs built up after all these years. Maybe it's a 401k that you moved in an IRA, but this applies to 401ks as well. If you've been taking the tax deduction on money going into IRAs or 401ks all these years, you've been deferring the growth all these years, now is the time where the IRS wants their money back. You've hit age 72 and you got to start taking required minimum distributions. Do note, this is an aggregation of all IRAs. Maybe you have all your tax deferred dollars in one IRA, which is fine, but if you have multiple IRAs, there's no hiding it. You're gonna have to calculate them all individually. The IRS views it all as one big pot of money. We're gonna do it in 4 steps. All right, first thing you're gonna do is you're gonna add up all the balances on the prior year, December 31st. So this year's RMD of 2022, if you're turning 72 this year, will be off the December 31st balance of 2021. Let's say that was $1 million. All right, number 2 is you got to use the proper table. There are 3 IRS RMD tables that you can use. The most common one is table 3, where it's your own IRA and you have a spouse that is not over 10 years younger than you. That's a different table. There's a few tables that you can utilize. I'm gonna hit a link below to all those tables in an article from the IRS website so you can help decide which table. We're gonna assume it's just the uniform lifetime table, table 3. And since we're gonna use that table and we're assuming that you're age 72, that divisor is 27.4. Step 3 is very simple. To find the amount, we're gonna divide 1 by 2. And an example of that is right here, $1 million divided by 27.4 equals $36,496.35. This is the amount that you have to take out in 2022. If you're late on this, there could be a 50% penalty. I repeat, if you're late on your required minimum distributions and you've done this before, or you don't have a good excuse, or your CPA is not gonna go to bat for you, if you're late on this and you don't take it for whatever reason, there's a 50% penalty of the amount that wasn't withdrawn from your IRA. So it could be another $18,200 that you gotta pay taxes on as a penalty because you don't take your distribution soon enough. And step 4 is repeat this process. You repeat this process if you have multiple IRAs, like I mentioned before, you have one at Fidelity and Schwab and Vanguard, you have a 401k, you gotta calculate them all. In addition, you gotta repeat this process every single solitary year until you pass away. And then your heirs or your spouse is gonna receive this IRA and they're gonna have to start doing some calculation, taking required minimum distributions as well. When you hit that age, if you have tax deferred dollars, there's no way to avoid this. There's some tricks, like you can use a qualified charitable distribution. Check out a video here if you want to learn more about qualified charitable distributions, but there's no way to avoid taking distributions out of your IRA when you meet a certain age. If you have any questions, please comment below. Subscribers have been asking a lot of questions and I'm turning those questions into videos. I'd love to feature one of your questions. Let me know. Thanks for watching.